Hello, everyone. This is Ken Winans and Stephanie Larson. And yes, I'm back in the Bay Area for my quarterly review with Stephanie and the portfolios. And we thought it was a great time to do a client video. And obviously we're past September, thank goodness. September, as you all know, is typically not a pleasant time in the markets, but I would encourage you, for some of you who I know everybody's a little nervous right now, but hey, the headlines are all horrible. We read them every day. They cause indigestion. Yeah, somebody's laughing. It's true. I mean, there's just, it's time to, in my case, I take my dog for a walk just to kind of clear my head. But what I would ask you to do is, one, I just wrote a new Forbes article. I rarely do financial projections, but as you all know, I call myself a historian who manages money. I am actually thinking the S&P could reach 6,300 by New Year's. And I think you'll find it interesting of how I backed into that math. But the bottom line is the fall is typically a really good time to be invested. With the caveat, it doesn't mean you buy the market. You have to pick individual groups that are going to do well. And personally, Stephanie and I have been really eyeballing the financials, particularly. Now that the Federal Reserve is lowering interest rates, that's the time you usually want to step into insurance companies, banks, investment firms. They typically do very well. And of course, Stephanie will talk about in a moment, that marvelous pop we've had in preferreds and bonds.
Yeah, well, actually, the market's been really interesting. We will kind of go over a couple things here, but one of the interesting things that we've seen in the market is there was a lot of new issuance in September. In fixed income, it was the second largest new issuance for fixed income investment grade of all time. The other time before that was during COVID, which the government was kind of trying to help everything at that time. It's investment grade though, so it's not a huge area that we like to play in. Everything's kind of around 5%. We obviously want more than that, so it didn't necessarily help our endeavor, but it was just interesting to see how much new business came to the marketplace. One of the things is that now that the Fed is cutting, I am seeing a lot of our paper get called. I think I mentioned this on the last call. There's even more. I just got another notice today about the Goldman Sachs bond got called, and I just can't keep paper. It's really frustrating to me. So, and then you're coming back into the market and you're trying to replace it. It's a challenge. I'm still doing it, but it's a lot of work and it's a lot of effort. And every time I come in, I see another notice. I just get so frustrated. So, but it's been okay. It's been interesting.
By the way, Stephanie just did her inaugural radio interview last night on KABC. So you'll have a chance to listen to that if you go to our website. I think it's under the media button. You'll see our radio interviews, and you'll be able to chance Stephanie and I and one of the other associates we deal with on fixed income. We're on the show, and you'll enjoy it. But let's a couple of things to keep in mind. And look, we know we're 45 days out from an election. It is interesting now that the company is headquarters in Las Vegas with 3 offices between Salt Lake City, Las Vegas, and of course Nevada. That you do get different perceptions on political things. What I would tell all of you, and many of you have known me for a very, very long time, I have said it every single election cycle: follow the Federal Reserve. Don't fight the Fed. And when you have the Federal Reserve beginning to lower rates, now it's not saying we're going to see rates go back to zero. None of us want that world ever again.
No.
But we are finding the Fed is no longer causing headwinds.
Yeah.
That is an important thing for us to look at as money managers to decide how we move your portfolio. Now, I will tell you, people ask me how confident are you? I'll be as confident as the January's performance goes. If we get into January and January starts falling apart because earnings are bad or there's something else hitting the world, we'll be more defensive at that point in time. But for this 90-day window, I have and Stephanie feels the same way, very high degree of confidence that we're going to be looking at what will be opportunities to make money. I would also just throw this out. Many of you were with me in 2008. 2008, as we all remember, was a horrible time. If you go back and look at it, in October, November, December, the market was actually net up in the middle of a major bear market. So it is, during that time of year, although it can be volatile, you generally have a positive bias.
I will also say that one of the things that I'm hearing a lot from clients is a concern, because if you kind of look the last 11 months, we've had this huge rally. You know, we at the end of the year, of this time at last year, we were like, hey, I'm hoping for a really strong Santa Claus rally. We didn't get one the year before. And right at the end of November, it just took off. And if you look at some of the stock charts of some of the names in your portfolios, you'll actually see what I'm talking about. And it just kept going. And then we got into January. We're like, oh, January is the bellwether month. Let's see what it does. It kept going and it kept going. And even this summer, we had a small pullback, but it wasn't that bad. And then it's just kept going. And September is a dangerous month. But when you have a solid or an okay September, the end of the year tends to be really good. So this is actually a really long, prolonged rally. There's been a rotation for sure, but you know, I do feel, and I was saying this before, that when the Fed cuts, I feel there'll be some more juice in the market. We're getting that juice right now. We're going to take advantage of it and really up our beta in our portfolios, really increase our exposure. But it's been a lot. So we have clients that are starting to reach out and say, hey, we're really overstretched. Hey, you know, aren't you concerned? They're listening to the pundits. We're very aware that the market's overstretched. We're very aware of what's been going on with it. But those clients are trying to call the top. The pundits are trying to call the top, and we're just not there yet. We're going to have the market tell us what it's going to do. We're going to seek confirmation on that through different signals and things that we look at. But we're not going to just, you know, pull out because it feels overstretched. It does feel overstretched. It is overstretched, but it's still going. So we're going to play the seasonality. We're going to play the history. We're going to play the numbers. And we're going to let the market tell us when we need to back out of it. And we're just not there yet. So it could change on a dime, like for sure, but we're just not there.
Yeah, and you know, we don't, and our decision has always been just follow the crumbs, follow the breadcrumbs. And right now, our market research is, I think 77% of our indicators are positive. The other ones are neutral. We have nothing negative right now. That's very, very rare. But also just one other quick thing. What we're not saying, we're going to go into earnings season. There will be good, bad, and ugly. This new port strike that's happening. I was telling Stephanie earlier today, the last time we had a prolonged shutdown of ports was during COVID. That caused massive inflationary and dislocation issues. For those of you who remember, we couldn't find toilet paper in the stores for about a month. Okay, I mean, hey, I hate to be graphic, but it's true. But anyway, it is what it is. But anyway, I'm just saying that these things, this is part of what you pay us to do, is to try to ascertain the threat level. But so there will be some companies that do not do well this earnings season. We get rid of things without hesitation or remorse. I mean, I'm not one to fall in love with a company or a symbol. I actually am of the opinion it's not popular amongst a lot of people, but I don't think tech will lead this next run in the market. The entire third quarter, I'm not talking about NVIDIA or Apple, I'm talking about looking at tech in general, was actually flat. But finance was up, services were up, utilities were up. So very clearly there's a shift in leadership. But I do want to briefly bring up something else, you know, Stephanie's wheelhouse, is that I want you all to be thinking about in your portfolios. For a very long time, we've had a flat yield curve, meaning that there was no benefit to buying a longer term bond because shorter term bonds were the same yield. You are going to start seeing your average maturities are going to start migrating out. I dare say that I think within the next 2 years, when we look at your average maturity, it's probably going to be averaging at 5 years, maybe 6 years. So just even though you're older, I know many of you are saying, well, wait a minute, I'm older now. We have to go where things are in the market, and it's more important to, and then also preferreds.
Huge pop.
A big pop in preferreds. And I would also venture to say that we'll probably end up as a percentage of your income portfolio part, or if you have a balanced portfolio, that segment of income, don't be surprised if you find more preferred shares in that side because there's opportunities. Steph, would you like to add to that?
Yeah, I would agree. I mean, the preferreds, I know I need to buy some, so I'm trying to find the right price level that I can get in at, because right now they did have a huge pop. I need them to come back down just a little bit so I can actually buy into them. You don't want to overpay for preferreds. Yeah, I agree. I concur with the fixed income. I mean, I am trying to go out a little farther. I'm still trying to stay 6.5 to 7 on the yield to maturity. I'm getting close-ish there. It's a little tougher without going too far out the risk spectrum. So there's a nice little balance that's coming in on the fixed income side. Yeah, you'll have to go a little longer. That's just the case. I mean, the short paper is giving you 5 or less. It's just, there's nothing there. I'd rather, if you're buying high yield, you're getting 5. I'd rather buy investment grade and get 5 and have higher quality. So it's definitely a tough environment to navigate, but I think we're doing very well with it. The portfolios look fantastic. We just ran the pre-reports for quarter end today. The numbers look great. The portfolios look great. We're very happy and proud with what we're doing. We're going to be pretty defensive if anything changes, because we don't want to give back what we worked really hard for this last year. So.
Well, and then we're, this time of year, we're always on pins and needles because as you see, the firm behind us likes to grade us. So it's like getting a report card from school.
That's true.
But I'm fully expecting that Morningstar is going to reaffirm their rankings of us being, I dare say, one of the better managers in what we do out in the world. So I'm very happy about that.
Yeah.
A couple other quick things. Many of you have asked about my travel schedule. This year is a little problematic with me traveling to California because there's, not to get into it, but if you're here more than 6 months in a day, California sees you as a citizen. So I'm trying to show that I am in fact a Nevada resident. But going into 2025, I will have a normal travel schedule. I'll be in California. I'm going to try to come out quarterly, or if any other time when it's needed to. Of course, I'll fly out. It's only an hour by plane. But anyway, that's kind of the way things are. I just want to say very quickly, thank you to our clients. You're just, I've gone to conference, and Stephanie's going to be going to the Schwab conference next month.
I have 3 conferences this quarter.
she's-
I did the one for Access, and I have this CEO leadership one that I'm doing in Utah, and then we're doing the Schwab conference at the end of the year.
And I was just back in Washington, D.C. with the Nevada Chamber of Commerce, and that was also very interesting. So we are, not that, we're obviously doing our jobs, we're here most of the time, but we are having to get out. But you will be seeing us. I wouldn't, so one other quick thing, I always say this to everybody, I don't like mid-course corrections. Let's finish out the year with whatever your allocation is. Let's look at January. Let's then have your year-end meeting sometime between January and February. Talk about your strategies. We can, obviously for us, we are we cover many different type of strategies. We'll be able to move on that. The other part of it too, as many of you know, we've added an office in Salt Lake City that has a wealth management division to it. So you talk about things like trust, family foundations, planning, taxes, all that stuff. We now have that capability. So let us know if you do in fact want to meet with our associates from Salt Lake, and we'll take it from there. But
yeah, we've actually had several clients already take us up on that. They've had an extremely positive experience. We're very happy about that. Our new partners in Salt Lake are wonderful. Ben and Tom, we will introduce them to all of you guys. And the other thing is that it is year end, so there's a few housekeeping things we're working on. I know that Amy is reaching out to all the clients slowly. She's making her rounds about your annual check-in with her. If you want to pass, that's great, but she loves to just touch base with you guys and make sure everyone's okay. We have RMDs, so Mindy's working on the RMDs, and we're going to make sure all of those get processed. And then on my end, I will make sure that I'm going to do a review of everybody's realized gains and losses, and any tax loss harvesting that we can do, we will do. I'm not gonna lie, because performance has been so strong, there's probably not a lot of harvesting that I can do, but if it's there and you need it, I will definitely do so. Any year-end planning that you want your CPA to talk to us, please reach out. We have one last quarter, and just don't shove it to the last week of the year, because it just won't happen. So yeah, just make sure we do some planning. We have a whole quarter here to work with. Just let us know what you need.
Exactly. And then I guess the offer always stands. Any of you who would like to come out to Las Vegas, especially this time of year, it's beautiful out there. Love to have you come by the office, show you the new operations we have out there, and we will try to. We're talking right now about possibility of another client type. I don't want to call it a Winans conference, so to speak, but some kind of a gathering where we can get together and have some speakers. Maybe it'd be a good time to have Ben and Tom come out and talk a bit more about things like that, but we'll get back to you on that. Amy's putting some things together going into next year, but listen, we just hope you all have a good fall. Summer's over. Hopefully things will cool off a little bit for all of us, weather-wise, and be able to, hopefully not.
It's 100 right now.
Hey, I've gotten used to it. Anyway, it's, anything below 100 is downright
He
bombing.
brought the weather to California. Go back.
Oh yeah, well I'm a little
away.
tanner too, so I have a bit more of a tan than I used to. But anyway, listen, we hope you're all doing well, and we hope to hear from you again soon. So please take care.
Bye guys.
Bye.